Who joins us from Alpha Broking, who's live in our Melbourne studio. Markus, good to see you there this afternoon. Now, we're just talking about some of these bigger miners, the iron ore miners. That iron ore price still continuing to defy the odds, remaining very, very solid. What is your thought on the valuation, say the likes of BHP and Fortescue? I mean, do you think it's time to take some, start taking profits off the table?
I think Scott summed it up really very well. I think like the BHP is your diversified play, but coming back to actually the key money-making commodities of the export in the US, in Australia, iron ore and coke and coal and whatnot, we feel there's a bit of a disconnect as we think the energy-type commodities are definitely lagging behind your other mining commodities, such as iron ore in particular. We feel that iron ore is in a peaking scenario price-wise. We see it in many indicators that we look at in numbers. I think this is as good as it gets. As long as iron ore trades between $75 and $80 a tonne, it's a bonus for Australia. The longer it holds up here, it's just fantastic. Realistically, we feel this first quarter could very well be as good as it gets type quarter. We expect a top out in Fortescue sooner than BHP this quarter, but also as BHP, without jumping the gun, a top out over the next 6 months to us is a very, very fair expectation. They build in just about all the potential good news. I think separate to iron ore related stocks that really benefit out of this price level now, I think there's for us much more shift towards oil related stocks and gas over the next 2-3 months. As you know, we really like Santos and Woodside for different reasons, but generally as an oil and gas play. And we think over the next 12 months, they will definitely outperform any stocks that are iron ore related or coke and coal related, such as the steel industry related type stocks.
Markus, Scott Phillips here from the Motley Fool. You mentioned oil and gas. There's been different talk recently about the differences between the oil and the gas price. We know they're absolutely different prices, but the linkage is there. Some people saying there's just a matter of time before they become back into some sort of direct relationship. Other people saying there are different issues at play, particularly when it comes to supply and demand and the commercialisation costs. Just remind us, what's your view on the combination of the two, and how would you play that specifically?
Well, we don't trade the sort of oil and gas spread as such, but we trade individually. As you know, I mean, the macro cycles are intact. And, of course, over a 3 or 6 month period, they diverge to some degree. I mean, natural gas is naturally much more volatile than your crude oil, West Texas or Brent. So, look, really, as such, Australia is actually a very bad example when it comes to natural gas. It's a very ill-managed type of a commodity, we believe, in particular hurting our domestic market for no reason other than greed on the export price front. So, look, to me, we feel that generally natural gas and oil price are in a bull market. We have our base in oil. OPEC supports this base. The supply and demand scenario probably will eat itself away over the next 6 to 9 months. The futures market will have to build in future expectation at some point. We think that will start to happen over the next 2 or 3 months. So a break of $55 in oil, we think oil could go a lot higher. We actually changed our forecast over the last 10 days. We made a new analysis from a $45 to $65 range. We give oil now a $50 to $80 range over the next 12 months. We think this potentially could actually surprise on the upside in a big way. When it comes to natural gas, a different beast, different to play, but ultimately it's natural gas in a way has a lot more potential actually on the upside than oil. As we know, it's less a polluter and obviously a bit harder to get, and therefore we think actually natural gas has tremendous potential on the upside. So really we think we should play both together, but in individual sectors as such, and not so much short-term, get basically deflected by the short-term divergences, just basically go for long-term value when they offer that individually. That's basically our approach.
Speaking of the long-term, Santos is out with its production numbers tomorrow, of course launching that surprise capital raising just last month. I think there's the question now about where their growth will come from. Maybe we won't hear it tomorrow, but potentially in the upcoming earnings report next month. Is that a concern for you at all, where their growth will come from longer term?
Look, you sum it up, Leanne. I mean, really, what they really need is a major lift in the underlying commodities that they deal in, which is oil and gas. And that will ultimately give them the break. If they don't get that, there will be issues because the gearedness of it, even with the raising, you will probably get it under control. But looking at the management, and I took quite a bit of time studying what they're doing and how they're talking about their plan going forward, I think they've made a very good move to a new management that, in our view, should have been in place a long time ago in this good company. So I think if they have a bit of support with the underlying prices of the commodities that they deal in, oil and gas, they will get the sort of lift that we all expect. And that will need a break of $55 a barrel in oil in West Texas, and natural gas solidly about $4 on the trade basis. In the moment, we're about $3.40. So it is a geared play, and we feel it has a tremendous potential. But obviously, nothing goes without risks.
Mm-hmm. Can we just talk gold and I guess silver and platinum, because I know those are a couple that you follow. We're seeing a bit of a pullback there today, but overall we've been seeing this buying in the likes of safe haven assets such as gold and these gold stocks. So buying for hedge diversification, I suppose. What is your thought on the outlook for gold and silver and platinum for that matter?
Well, I think it has a lot to do with the US dollar as such, and of course the Trump factor. I mean, we're dealing with one thing about Trump, I think everyone agrees, is going to be bringing a lot more volatility to the markets, and uncertainty is a beast for markets, and I think he might, as much as people wish that he brings a lot of good, he most likely bring also a lot of bad or a lot of uncertainty to the markets. So when it comes to gold and silver, I mean, we still know that China is still a net buyer for the central bank, and to basically boost the gold stocks. We do see investor interest at current prices all around the globe, and I think it's just prudent. I mean, really, as you know, and viewers would know, I believe 10%, or if someone is really of the belief that gold and silver could go much further, as much as we think, we got long-term targets in levels that might look stupid to some people, such as $5,000 an ounce in gold. But if you told people in 1990 that Dow is going to be at 10,000 by the end of the decade and 20,000 15 years after that, they would have laughed at everyone. I mean, at the end of the day, you could always look at out of the square, and we believe we are running into major troubled waters. I mean, we're having now a credit market boom for 20 years. It's gone into overdrive the last 8 years, with central banks obviously in a quantitative easing cycle printing money, letting us believe we can live off monopoly money. Well, we'll figure out that soon, I guess. But basically, something like gold and silver, or for the youngest generation, the Bitcoin type of diversification, will have, in our view, a tremendous benefit. We have massive upside targets in the precious metals. Short-term, gold and silver and platinum, I think there's a bit of profit-taking happening, had a bit of a bounce, and the Trump inauguration, all that. But if you look at gold stocks such as Gold Corp, New Gold, Barrick, here domestically, I mean, Newcrest is again nice on track. Silver Lake is a junior gold stock we really favor a lot. Performed very well, basically rallied from 25 cents a year ago to now about 75, 76 cents. We have very high targets for these stocks, and we really believe rather than put the gold bulls such as myself into the fool territory or into the old world territory, I believe, and our team believes, that this old world type safe haven, such as gold and silver, will have a very, very dominant role to play when this whole house of cards starts heading south. And we believe this could well happen over the next 12 to 18 months. We expect major Western world asset price tops over the next 12 to 18 months in real estate, in equity markets, broadly. We think this is as good as it gets. We recommend clients to enjoy their life. It's beautiful out there. It won't be pretty when things head the other way.
Markus, Scott Phillips here again. You're very clearly saying this is not a hedge strategy, this is not a sideline strategy. This is the very core of what you're telling your clients to do, which is to stay away from some of those other assets that have been doing well, property, shares, other things, and get back into these assets to pretty much be all in on gold and silver. Is that what I'm hearing, or is it more of a hedging strategy still?
No, Scott, I think it's beyond. It's a hedging strategy for the ones who basically are involved in real estate and whatnot, and are stuck in these investments. For anyone who has a more liquid scenario, to me, it's definitely, I reckon, a 10 to 15% macro investment for anyone who's serious about making money.
All right, let's talk about, well, look, you touched on Donald Trump there and the upcoming inauguration. Just a broader macro view from you. Look, there's so many unknowns right now and it's all dependent on those policies being implemented. He's taking on a market that's enjoyed solid gains, an economy that's doing pretty well. Do you think that momentum will continue once he steps into place, his administration is in play? What's your sort of broader macro view of how things are playing out right now?
I definitely do. I think short term you might find that the market might have a bit of a correction and just takes it in strides. I wouldn't be surprised if the stock markets worldwide have a bit of a 5% pullback from the recent tremendous rally. But when I speak to my colleagues over in the US and in Europe, I mean, there's a hell of a lot of bullishness out there in business circles, and particularly the US. They're really getting a kick out of the whole story. So that might be good for another 6, if not 12 months of happy days in the overall economy. If that translates into stocks getting priced to a level beyond belief, maybe, perhaps. As I said earlier, we believe we're going to see a major asset price top this year or next year, most likely this year, later this year, and that could be a top that could be quite tremendous. And so basically, yes, we think he'll be a good news story for the next 12 months, but we also do believe he'll be responsible for a lot of unnecessary grief and volatility, and ultimately that and the uncertainty that brings will be responsible for some serious negative effects on stock markets and asset prices per se.
All right, excellent. On that note, Markus, we're going to wrap things up there, but it's been great having you on the program as always. Thank you so much.
Thanks, Leanne.